Morning, Andrew.
Hey, morning, Chris.
How are you?
Not too bad. How are you?
Yeah, good. Are you prepared for the festive season?
Oh, getting there, I think. It's reasonably low-key this year for us, but we're just hosting a small gathering at home, and
Nice.
so
Hopefully you get to spend some time on the couch watching cricket.
hope so, mate. Hopefully there's enough cricket to watch.
Very true.
Australia go all right.
Now, we thought being December, this time of year is usually quite good because we typically do a pretty holistic sort of view through what's happening, but I suppose more in terms of what should we maybe be looking out for in 2025, maybe looking at some of the key asset classes potentially going forward for next year, and then just touch on, I suppose, looking back, I suppose, over the last 12 months, how portfolios have performed, which hopefully should give everyone a bit of an idea of where we've been and what are we expecting for next year.
Yeah, sounds good.
All right, so I'm going to call this one our Global Markets Update. I guess we'll look at this in sections. So section 1, I guess, is looking at the economic context. There's been significant market volatility.
Yeah, and it's just continued to play out, albeit the last few months it's stabilised a little bit. Things are starting to normalise. Inflation globally has continued to trend down, and that's created some corrective action through the majority of the central banks, in particular the US Fed. Australia, in Australia's context, holding firm. So they're still waiting for the RBA, are clearly waiting for that to drop further.
Yeah, correct, waiting for the data. And I think that's interesting. And for those who have been watching regularly, the theme has been I feel like a bit of a broken record sometimes. It's just we've been focusing, what's inflation doing, what's the data telling us, and then therefore that's driving central bank policy. And the uncertainty around the directionality of that policy has created the volatility. And so essentially what's happened over the last couple of months, we've had more certainty about that directionality being down, and therefore markets have been a little bit less volatile, which has been nice, and it's added some extra return to client portfolios.
Yeah,
so
correct.
Outside of volatility, we sort of touched on the US a little bit. It seems to be, although listening to some of the podcasts over the last few days, not flying in the face of this, but that inflation is continuing to ease.
Yeah, and that's which is quite interesting, given that there's also and the talk around soft landing. So it would appear that things are slowing down, but employment's still holding pretty strong.
It is
not only US but also domestically here.
Yep.
So there's that. Yeah, there's different data sets that are one pointing to inflation, getting towards their target, which is around 2%. I think they're trying to get inflation down to, which is the Fed's target. And but on the flip side, the resilient economy, which is showing that employment remains reasonably strong in the US for now.
Yeah, and it's been almost the perfect scenario, really, isn't it? Because if I think back to what we were worried about maybe 12 or 18 months ago, the worry was that we'd see inflation falling off a cliff, and jobs growth and economic growth would be poor, and we'd have a deep recession. That was the big concern, and that hasn't eventuated, which I guess is a good thing. But a strong labour market is a positive thing. I guess it's just that plays into, I guess, expectations for inflation, and whether it's a rapid drop or a gradual drop, and obviously we're hoping for a gradual drop, and I guess that points to your, if you want to use the market term, the soft landing. But it seems like the US have mostly navigated it. I suppose Trump's, which we'll get to the political aspect, but it just creates a bit of, instability given his irrationality. Looking forward, I guess, what are the areas we're expecting to drive growth for us in 2025?
Well, it's probably more of the same around, cheaper cost of debt and financing that'll allow the economies to maintain some momentum and perhaps reinvest in or new investment.
Yep.
So that'll allow GDP in particular to start to show signs of improving. So I guess that's one of the key things will be on the radar for the coming year.
Yeah, definitely. And I think if you think geographically in the sense of who's furthest down the path, I suppose because in the context of the last couple of years we've had the inflation issue. So who has been able to get hold of the inflation issue without killing the economy essentially? And the US is the one who's probably done that best.
Very well. Yeah.
If we look at Europe, maybe some of the countries have done okay, some haven't. But if you look at the Eurozone as a collective, it's probably looking a bit weaker. The UK is probably looking a bit weaker. And I think here in Australia, it's still unknown. There's a sense of, as you said before, we don't have the data yet. So I guess the US is probably the most well-positioned in terms of we have inflation under control, interest rates are coming down, we've still got economic growth. Historically, that puts you in a position to say, you get your best asset returns out of that environment.
Yeah, that's right. Yep.
So then, looking closer to home, here in Australia, I guess do we have any thoughts on? You kind of mentioned before about where we think we might be.
Yeah, it's. Clearly, as I touched on before, and the RBA have been quite strong in just they're really focused on getting that inflation number down, and it is trending down, but they're still concerned it remains slightly elevated, and some of the recent reductions have been pointed to the gas and electricity subsidies that have been implemented, along with potentially tax cuts at the start of the current financial year. So they're sort of they're still worried that inflation is still a little bit high, and it's kind of all out on getting that inflation down further. Again, unemployment is remaining fairly stable around that 4.1% mark. It's been there for quite a while. So I think it's going to be the challenge will come when, if and when the rates start coming off. Yep. And you talk about one or two of the banks probably 3 or 4 months ago were even arguably putting forward a rate reduction this calendar year, this calendar year.
Well, some of them were saying December. So,
yeah. And then they sort of push it to early 2025, and some of the latest commentary now is even the middle of 2025.
Yeah.
Clearly, some of those banks will be right and some will be wrong. So they're probably hedging their bets a little bit there. But and then it's a case of how far do they go and how much damage may have been done in the meantime. There's talk of effectively a 3-speed economy where you've got renters, house owners with a mortgage and house owners without a mortgage, and the spending patterns for those three classes is vastly different.
It is, isn't it?
Yeah. So the longer sort of the interest rates remain somewhat elevated, that might put further squeeze on those that hold a mortgage.
Yeah, it's definitely making it hard. All right. So staying global or moving back globally, I suppose, China is obviously one of the biggest economies in the world, and they have had, I guess, a bit of an issue with internal demand from, the Chinese consumer, whereas the rest of the world, it still remains that from an economic sense, using China is still cheaper from a labour and goods perspective than the rest of the world. So there's still that, that trade, even though that cost, that margin is increasing as we start to see the societal lift in China. Basically, they've introduced some measures to, address what they're calling the issue of insufficient demand internally, because Trump getting into office creates a real issue for them, where if any of those tariffs land, and they land heavily, it could be trouble for exports from a Chinese perspective.
Yeah, that's right, and particularly Australia as well.
Yeah, absolutely. So it's the Chinese government have stepped in, introduced some stimulus measures there. So it'll just be interesting to see how that plays out over the course of the next 12 months. But yeah, I really think Trump's political agenda is definitely going to play a part. But for now, from a Chinese equity perspective, that's been a positive. But I would expect that over the next 12 months, again, depending on Trump, that I guess Chinese equities and Chinese companies are going to experience significant levels of volatility as the market reacts to that. So I've spoken quite a bit there about Trump, and that's, I guess, the political elements. So what are your thoughts, Andrew, I guess, on some of the political developments that have happened over the last, really, it's only the last few months?
In respect to the policies that Trump has come out with,
Yeah.
So clearly he's been quite vocal around protecting US manufacturing, and his way of dealing with that is through the use of tariffs, which is a clear go-to strategy when you're trying to protect local manufacturing. I guess the question or the issue remains as to how deep and how far he will go. So clearly he's got China in his sights.
Yeah, he does.
And that's been quite prominent that China might be the first to be exposed to an increase in those tariff levels. But to what extent is probably a little bit unclear at this point. And then does he go broader than that with imposing tariffs on other companies? So there's a view there that if it's isolated to primarily China, well then yes, that will certainly have an impact on GDP globally. If it goes broader than just China, then it'll have more of an impact.
Yeah, definitely. And I think from a tariff perspective, the general view is that then that's going to be inflationary within the US economy. And so one of the, I guess, concerns maybe markets have is that if we've got inflationary policy, high US dollar, I guess obviously that's good for US equities, but from a global perspective, does that create any level of uncertainty because you're essentially creating policies that go against what the whole global trend is in terms of trying to get inflation down and rates down. So it's just a big, really unknown, isn't it? Which is my comment before about him being, was it erratic? I think
irrational.
Irrational, erratic. It just makes it quite difficult, I suppose, to plot a path from an investment perspective because there's no sense of certainty, I suppose.
No, and add to the tariffs. I think there's also some commentary around tax cuts and also some fiscal spend. So that'll all potentially put further pressure on inflation, as you were just talking about. That'll start to unwind some of the action that's been taking place over the last couple of years.
All right, so in this section, I guess we're just going to touch on the asset class views, and I think we'll maybe touch on, as I said before, how the portfolios have performed or behaved, I suppose, over the last 12 months. But from an overall risk positioning standpoint, I guess the key risks that we kind of see looking forward to for 2025, we've kind of covered, really, haven't we?
Yeah, we have. Yeah, so it's all around unemployment or employment and how resilient or not that remains. What interest rates ends up doing, how many further cuts may play out in the US, and when will the RBA start cutting and how deep will they go? And then a couple of minutes we're just chatting around the Trump effect and how what's going to play out there.
Yeah. I think the thing that's really striking me here is that a lot of this is very US centric.
Yeah.
And the US leads the world typically anyway. I guess it's the economic leader, and what's the adage? It's like US sneezes and the rest of the world catches the cold. I think is the. I don't know whether I've got that wrong or the wrong way around, but it really is at the moment in terms of the US has weathered the inflation, I guess, concerns the best. They're best positioned from in a general economic sense to grow from. So I guess there is some risk that the rest of the world continues to deteriorate. That's probably a risk. But it feels like at the moment there's really a lot of focus about what's happening in the US and what that means for the rest of the world. So government bonds. Bonds have been an interesting ride for the last few years, but it's been a nice ride for the last 12 months as rates have come off.
Yeah, that's right. So obviously, as we've spoken about previously, the prices of bonds have an inverse relationship with interest rates. So as we went through the interest rate increase cycle, the prices of those bonds were coming off because of the effect of new bonds at higher offerings. So there's got to be a correction to the bonds already in the market, and with the last 6 to 12 months, as the inflation measures globally, and particularly in the US, have started to become under control, then that's had an effect that the markets then start building in impacts around proposed rate reductions. So to that point, again, the inverse relationship, prices of bonds improve, and for those that have the chart in front of them, you can see those yields have improved quite dramatically from 2 to 3 years ago.
It really is. It, I guess if we had the left-hand side of that chart, we'd probably see the downward trend there. But basically, as you can, for those that are going through the charts, we can sort of see that most bond markets are neutrally priced, which is a good thing. But bonds have been a really dirty word for the last 5 years because of where interest rates have gone. I think they still have a really important part to play in portfolios where I think because of there's been such poor performance for the first time in decades, that it's really, I guess you run the risk of overlooking it, essentially. And I expect that there might be a bit of a turnaround here going forward. All right, so equities, I guess this is more generally from a global perspective. I guess our view looking forward for the next year is a neutral view, I suppose, especially over a 5-year time horizon, because we've had some pretty strong equity returns over the last 12 months, which would typically mean that expectations for equities probably shouldn't be as bullish in the coming years.
Well, in fact, I think the ASX 200 hit 8.5 yesterday for the first time ever, and the S&P 500, which is the US index, is at all-time highs as well. So there's a fair bit of heat in the market.
There is.
And despite some of the risks and the factors we've been talking about, not only today but in past months. So it's will they remain at those elevated levels or they come off? But I think it sort of does give you a view that how much further can they go in the short term?
Yeah, absolutely. Yeah, it's interesting because I think we were doing some portfolio, which we'll come to, portfolio return numbers for clients, and it's the first time I've seen 20% returns for client portfolios since pre-GFC. Not that I'm forecasting GFC to arrive, but I just thought it was interesting that it's been quite a long time since we've had those sorts of numbers. Double
digit, not necessarily unseen, but when when it's got a 2 in front of it, that's a pretty strong result.
Yeah, it's a great result.
And you take it when you get it.
Correct.
Absolutely.
Yeah, exactly right. And so my view then is, well, hasn't that been a great year? And for those clients that I see, my typical response is then, well, we shouldn't really expect this next year. I'm not saying large negative returns, but it's not. You don't consistently see 20, 20, 20, 20. It just doesn't happen. So, as you said, you take it when you get it. But what that means from a forward view is that you try not to get too excited about it and caught up in the irrational exuberance, I suppose.
Stay the path. Stick to your strategy.
Definitely. All right. So, as I mentioned a couple of times earlier, I think we wanted to just dive into, I suppose, how looking back. So I guess we've done a bit of a, maybe things to think about. What are the risks that we're facing for next year? Where we think things might go okay, and then now to sort of look back and say, well, what has happened over the last 12 months or so? Probably even further back, because I think that's instructive for something like, I guess, what we're calling IWP Lifestyle Model 3. So from a a numbered perspective. 1 is our lowest risk, 6 is our highest risk, and so we have a suite of portfolios that run in between that. But lifestyle model 3, I guess, is our, I guess you'd call it our moderately conservative portfolio. Andrew?
Yeah, that's right.
Yep.
Yeah. So effectively an equal weighting between growth assets, those growth assets being equities, property infrastructure type investments, and 50% being defensive, so cash, bonds, term deposits, fixed income. So yeah, it's 50-50. And the 1 year number has been exceptional for that type of portfolio.
Yeah, it's like I look at that for a moderately conservative portfolio. 14.8 is significant, and I think that comes back to the point that we were just making about bonds.
Yeah,
We're very unloved over the last 5 years because of just the interest rate dynamic. But then interest rates have been coming off, and those who have, I guess, held on during, which is, as we continually say, stay the course, you've seen significant uplift whilst equities have been going up.
yeah. So both of those asset classes has performed well for them in that period.
Correct. And so I think it's important to note here that the Bloomberg Ausbank Bank Bill Index is effectively the cash rate here in Australia. And so all of our portfolios have a cash rate plus like a performance number that we're trying to achieve over periods of time. And so you can see there that, obviously over 1 year, portfolio's done well, but we're always looking for longer term numbers because 1 year can be aberration.
That's right. Yeah, as we've seen, and you go back through history, and you'll see that time and time again, both up and down, positive
correct.
and minus.
Yep.
So it's all about the long term, and even when you start looking at the 5 years, and since inception, which is a little bit longer than 5 years. So the 5 year number, 4.9% average return per annum versus that benchmark you spoke about, 4.6. So it's met that objective, which is the intent of what we're trying to do with these portfolios is hit the return objective.
Yeah, and to have a 2.2% outperformance that's a per annum basis too, by the way.
Yeah.
For a moderately defensive portfolio has been really great because it essentially, the thing that then underpins this from a financial planning perspective is then the client outcomes.
Yeah.
So that just means that clients have more options, I suppose. And so to be able to, deliver that over, it's pretty much just about 6 years really, is just, I think, from personally a selfish perspective, it's just great to be able to talk to people about that and say, well, we're well above where we thought we'd be. You can take that holiday or help the kids or whatever it happens to be.
Yeah, which is all very important for those that are in that position.
Yeah. All right. So we call this the asset class attribution. So it's just so it's essentially where the returns have come from, and you can see there, I guess, in the table on the right hand side, if you the CYTD calendar year to date, global equities have had a significant contribution to that number. Also, Australian equities have played their part, but everything else across the board is essentially adding positive numbers in there, other than currency, which is a marginal negative. But that's, I guess, speaks to, I suppose, what have been the return drivers for that specific portfolio.
And again, just talking about, we've been talking a little bit about bonds in this session today. And if you look at the fixed income row in that table, so the calendar year to date, so 9 months through to the 30th of September, the return contribution has been 1%, whereas the last 3 months has been 1.4%. So again, that highlights the recent uptick in the bond prices.
Yeah, correct. All right, so lifestyle model 4, this is our, I don't want to say the most popular, but it's the most invested into, I suppose. And that's primarily because it's our balanced fund. So this would be a classic 70-30 growth defensive portfolio. Obviously the bell curve or the distribution for most clients that we see would want a balanced approach. And so we can see here, it's a pretty similar story, really, except that since inception numbers probably a little higher.
Yeah, it's been quite strong. So clearly the 1 year number at 18.2% has been phenomenal with that allocation of 70% global equities.
Yep.
And even the 5 year number 7.3% per annum, and then since inception even stronger.
Yeah, correct.
So that's why time frame is really important. We often talk about sticking to the strategy, and but it's also staying invested for a long period of time.
Yeah, that's right.
To set your portfolios or clients' portfolios up to be able to generate those average long-term returns.
Yeah, that point is huge, right? Not trying to, I guess, get stressed about, what's the shorter-term stuff. Like in this instance, I know we talk a lot about what's going on politically in the US, but realistically, with Trump, that's a short-term proposition.
It is, yeah.
Unless he changes the constitution, let's hope that doesn't happen, to not serve more than a second term, in 4 years' time, he's out. And this is not coming at it from a political standpoint. I guess economically, it just brings more uncertainty, right? So whatever happens, it's just then about, well, we're in this for the longer term, more than just 4 years. So we build these with a really clear intent and a really clear set of mandates to deliver this sort of outcome.
Yeah.
And it's just really great to be able to see and present that the philosophy is working and does work, and we hopefully expect will continue to work through time, because we're not trying to. We don't think that we're smarter than anyone else in the world.
Yeah.
Essentially.
Yeah.
So, but yeah, I think that is 4% per year. Our performance versus its benchmark is a really great outcome. In terms of where did that return come from? It's a similar story.
Yeah, absolutely, across the board, and we've spoken about equities have been quite strong, both globally and domestically. Even emerging markets has been performing well over the course of the last few months.
Well, and that's another, like bonds. In periods of uncertainty, your riskier areas just get absolutely panned.
Yeah.
And because we're starting to see some stability come back into the world, emerging markets is one of those spaces as well. And I guess the property and infrastructure, same thing, right? So it's been a very difficult period of time, but we're now starting to see some of these numbers that we would typically expect. Because I think if you ask most people anecdotally, how have their investments done over the last 4 or 5 years, most people would say haven't done very well. So
yeah, that's right.
Yeah, it's nice to buck the trend, I suppose. And Lifestyle Model 6, as I said before, is our highest growth portfolio. And again, similar story, but you can see that since inception number, it's just an even bigger outperformance, really.
Yeah, it's well, this has got a 97% allocation to growth assets, probably equities. There's some property infrastructure assets in there as well, but again, another really strong year, and we're talking about returns with a 2 in front of it. Well, this portfolio's 23% for the 12 months. Very, very strong. And again, the longer term numbers, so 5 years, average return 9.7% per annum, and since inception, even better, 11.9%. So really, really strong set of numbers. And this is our anchored around our investment philosophy, Chris, isn't it? Which is not.
Absolutely.
We're not trying to beat the market. No. We're just trying to set clients up with returns commensurate with market returns.
Yeah, correct. Yeah, and it's just focusing low fees.
Yeah.
Like what are your end outcomes? Again, I sound like a broken record sometimes. It's just our sole focus here is how do we maximise your outcomes without taking like excessive levels of risk, and that's driven by the return, less the cost to access the return. I don't even know what the number is anymore. I used to know these numbers off the top of my head, but the fee in lifestyle model 6 is like ridiculously cheap comparatively to the rest of the marketplace.
Yeah.
And it just means for those who are willing to take the ride, because obviously this is our high growth portfolio. So when things are down, you take the downs, but when things are up, you obviously you pick up the returns. But I know from talking to clients, there aren't many people out there who over the last 6 years would have seen a 12% per annum return. It's just not out there. I know I'm beating my own drum here, but it's outstanding, I think.
Well, it's probably something you hope or you dream for, but you wouldn't think you necessarily would get that outcome.
Yeah, definitely. All right, so it's probably that's enough self-congratulations from the both of us. But I think it's just really interesting to touch on this, because you go through periods where things are hard, and we've had a lot of ups and downs since 2020. We've had COVID. Obviously, we've got a global war going on with Russia and Ukraine. We've had inflation concerns which have been extended over periods of time. We've had political concerns. We've still got geopolitical risks all throughout the world. And we've had periods of significant drop-offs and then pick up and then drops off and pick up. And I feel like if we look back historically, we've probably had what you would expect in a decade condensed into like a 4 or 5 year window. And it's been a really concerning and stressful period for investors, I think.
Yeah, I think that, and the sentiment also from media and the news, and every time you turn the news on,
exactly right.
It's not necessarily doom and gloom, but there's a lot of negativity around, and as people and consumers and watchers of TV and listening to news, etc., read the news, we absorb all that, and often you concentrate on, it's natural to probably focus on the negative side.
Or hard mode, right?
And what's it mean for me? But to then I guess have this sort of session and just summarise things, and as you've just done as well, I think it's been quite helpful.
Yeah, it's good to look through. To your point before about long term, you kind of got to try and look through the noise, and that's what we are trying to do every day for our clients. Is to say, let's not react to this short term thing, because our focus is long term, and we've set structures to deliver those things in the long term. And it's not all about money, because it all then comes back to, well, then what options does that provide you?
Yeah.
So, because ultimately, money is a tool to help you live the life you want to live, and that's the philosophy that we hold internally, and it's through all of our decision making. And I guess this is why.
Yeah, 100%.
All right, I think that's probably longer than we intended, but hope everyone has a really safe and happy holiday period, and for those who are spending time with family, hope you love that rather than wanting to strangle your loved ones. And we will see you all next year.
Have a great Christmas, everybody.